Good morning, guys, and welcome to the podcast. I've got a fantastic guest for the webinar today, David Doss, MBA. He is a fund manager in the blockchain and alternative assets economy. His talk today is going to be about building wealth and managing risk with digital assets. It's going to be about 25 minutes, and I'm really happy to have him. And so, David, take it away.
Yeah, appreciate you having me on your program again, Chris. It's a pleasure to be here. And yes, so the goal today is to provide you with some actionable kind of snack size insights on the digital asset space. I'll try to move fairly quickly to provide a broad overview, but I would be happy to continue discussions about any of the aspects of this with anyone who is interested. So real quick, just a few notes here. So this is not individualized financial, legal, or tax advice. So please consult with someone who is licensed and qualified in those relevant arenas and familiar with your specific situation before making any decisions. Also, just briefly about myself and my team, just to give you a context of who we are and what we're doing. So we're a group of professionals in the digital asset space. The space itself having only been around for a little over 10 years now. Most of us have at least 5 years in the space. For me, going on 8 here in the blockchain and digital asset space. But beyond that, we all have expertise in areas like traditional finance, established enterprises, and digital transformation, having worked in companies like BlackRock or Department of Defense, Citigroup, PwC, etc. So what we're here to do is to help people and organizations to bridge the gap between these emerging high potential opportunities and establish systems and frameworks that everyone is familiar with in the finance and business and investing spaces. And also just briefly on some of our network and partners. So we are passionate about building out community, global business and investing community. So with some of our partner organizations, we've helped to organize private events around business and investing globally in places like in Davos, Switzerland during the World Economic Forum, in Beverly Hills during the Milken Conference, in Dubai, London, Cayman Islands, various other places. So with that, to the main topic at hand, just as a broader focus area, oftentimes what people hear about in terms of digital assets in the news is usually either the terrible things or the amazing things, and not very much in between. And it's kind of job security for a lot of journalists and media to talk about the up and down of Bitcoin price and make it kind of a bit sensationalist. But that being said, it's important to bear in mind that in general, there are risks towards undiversified wealth and towards inactive wealth in general. And that applies whether it's in real estate or in the stock market or the bond market, as well as any other markets in most cases. So just as a few examples here, these are scenarios where in those particular timeframes, these assets were actually riskier, more downward volatile than Bitcoin or crypto assets. So we've had real estate bubbles burst with the real estate market falling by 20, 30, 50% on various occasions. We've also had the 10-year T-bond decline by 97% over a roughly 40-year period. And also during COVID, the stock market crashed much more severely than did Bitcoin. So these are all areas to simply bear in mind that any asset can carry risks, but when properly managed, properly diversified, and gone about with a game plan that's productive, a portfolio can be set up for long-term success. Also, with that in mind, just looking at Bitcoin price returns in 2023, 2023 itself was a year when, for most of the year, Bitcoin was everybody's sort of favorite scapegoat or kind of critical talking point. It was largely a down year, but even that being said, it was by the end of the year up more than any major index in stocks, bonds, gold, oil, etc. So to that point, it is increasingly becoming a blue chip asset in a way that many very serious players, ranging from BlackRock to ARK Invest, Forbes, are starting to normalize and gain acceptance for. Also, with that point in mind, is that like I had mentioned previously, assets in general, carry volatility, they carry risks, but a well diversified portfolio across asset classes can smooth out some of that volatility and risk. So here are some examples of where sometimes when we've seen oil or bonds or stocks zigging downwards, we see Bitcoin and digital assets zagging upwards. Point being that a minimally correlated asset and asset class such as digital assets can be a tool in a larger tool belt, larger tapestry of a healthy investment portfolio for many people. And a little bit of other data on the same topic here for those who may be curious. So with that in mind, as I've been mentioning, there are major players out there, including Forbes, ARK Invest, BlackRock, that are recommending what I would call small but mighty allocations in the digital asset space. So this can depend based on portfolio size, the goals, the risk reward profile of any individual. But for some very large institutions, BlackRock and similar organizations have been, in many cases, recommending somewhere between 0.5% and 2% allocation of net worth or overall assets into Bitcoin and digital assets. In other scenarios, we've been seeing others such as Forbes or ARK Invest recommending even larger allocations, which range anywhere from 1% to 20%. If we also look at this from frameworks such as modern portfolio theory, would also tend to agree that somewhere roughly around the 5% range is an area where basically that small but mighty allocation can be a risk-adjusted value add to a larger portfolio. I co-wrote an article on this that was published in the Bitcoin Market Journal. Would be happy to send it to folks who are curious. But also, just notably about this, actually, it's kind of interesting here that the overall crypto market cap had been slightly larger than the silver market about a year ago, is now much, much larger. So really just going back to that point that Bitcoin is now blue chip, is now surpassing the size of multiple Fortune 50 stocks, for example, in market cap. With that in mind, somewhat similar to other asset classes like the stock market, the real estate market, etc., it's important to understand fundamental values, utility, use cases. There's an entire ecosystem out there of digital assets that are solving for different use cases, providing different fundamental value. These range from things like stable coins to assets that are providing rewards through staking. Use cases include decentralized data storage, currencies, stores of value, smart contract platforms, file transfer systems, decentralized applications, real-world asset tokenization. The list goes on. But the broader point there being that much like in the stock market, where you have your high caps, your blue chips, your mid caps, your low caps, and where you have different verticals or different niches like let's say healthcare or industrials or financial services assets or technology stocks, Similarly, in the digital asset space, you have these different sizes and stages of assets, and you also have different use cases and sectors or subsectors that they are focused in. And so, to the broader point, most people who would say invest into the stock market would not simply purchase the number one asset on by market cap and call it a day. Many would diversify across different verticals, different market capitalizations, and use cases. So with that in mind, similarly to real estate or stocks or other assets, there's a wide variety of uh, different metrics and different signals that can be monitored and that can be used to make informed investment decisions to mitigate risk and to maximize upside. So, while there is a difference between the type of due diligence and asset evaluation that you go through in real estate versus the type that you go through in the stock market, at the end of the day, there are essential fundamental principles that apply across different assets. And the digital asset space is something that we believe should be part of that rule rather than an exception to that rule. So, relatedly, just looking at the drivers behind performance in the crypto and digital asset space, there are a number of key areas to mention. So, firstly, the broader tokenized and digital asset space is projected by major thought leaders such as Citi or the World Economic Forum to reach a global market capitalization of at $10 plus trillion by 2030. So in the next 5 to 10 years. And there have also been a variety of regulatory advancements, the kinds of sort of scary things that people have been seeing in the news in 2022 or 2023 really left the industry in many ways much stronger and more resilient. Relatedly, there's a groundswell of interest from institutions, high net worth individuals, where the vast majority of them are showing strong interest in digital assets, according to sources like Forbes or the Financial Times. There's also been exponential growth in the assets under management of crypto funds and managed services in the crypto space, and ultimately also as a testament to this, there is a overall consensus in the market of between $150,000 to $200,000 potential price for Bitcoin by the end of 2025, with notable thought leaders like Cathie Wood of ARK Invest predicting $1.5 million value by 2030. So with that in mind, as I mentioned, key factors to consider are to consider digital assets as a hedge against risk in other asset classes as a minimally correlated asset, to diversify across different types of digital assets when relevant, and to focus on minimizing risk through improved infrastructure, due diligence, and related areas. And ultimately, also, like other spaces, the digital asset space is something where total appreciation is possible. So much like in real estate, where you could have a cash flow generating property that also increases in value. Similarly, you can have those types of assets in the digital space. In terms of mitigating risks, here are some examples of risks that are important to consider in many situations. So there are, when working with digital assets service providers and others in the space, as with other areas of financial services, these are firms that can and should be able to be subject to third-party auditing or to oversight from regulatory controls. And increasingly, this is the case with the preponderance of credible players. It's also something where internal and external due diligence frameworks are increasingly becoming the norm, where rigorous asset evaluation are becoming the norm. where security practices are becoming the norm at an institutional level. Just real briefly, also on the example of an investment strategy in the space. It could be possible to. There are over 25,000, by the way, over 25,000 different digital assets out there at the moment. And so, while it's for most people impossible to acquire and maintain positions in all of those, it's also not necessary for most people to do. But this is an example of where diversifying across some assets that are more capital appreciation, others that are more yield oriented, similar to growth versus dividend stocks, diversifying across your high, mid, and low caps, and then your ultra early stage, similar to, say, having some angel investments, but also also allocating into, say, Google or ExxonMobil. Having that type of range of portfolio is something that is very possible in the space. A few other brief examples. Much like in other asset classes, digital asset space is a microcosm, increasingly not so micro as the space develops. But this is something where it's possible to invest into more blue chips or into more so-called altcoins, the rest of the universe. It's also possible to leverage more systematic and momentum strategies to capture short-term trends of what is kind of more trading style of allocation. It's also possible to allocate into tokenized real-world assets, basically that are backed by things such as the dollar, or backed by real estate or private credit, etc. Possible to capture yield through things like staking and lending. It's also possible to invest into mining operations, which are essentially more real-world companies that just happen to be driving value in the digital asset space, as well as ranges of structured products that include options, notes, etc. There are also individuals who choose to have accounts that are managed by professionals, or to invest into funds managed by professionals, or to invest into fund management companies as a different way to capture upside. But the broader point here being that planning, partnership, due diligence, mitigating risk is something that can and should be possible in this space. It's a space it's an asset class that is special, but one that's special just like any other asset class. The rules can and should still need to apply. So with that, would love to keep in touch with anyone who has questions. I'm pretty active on LinkedIn. I put out a lot of posts, educational content. Also on LinkedIn, my team and I put out a monthly newsletter with market commentary and insights. If you'd like to shoot us an email, info@CKC.Fund, we'd be happy to keep you posted as well on sending our monthly market commentary via email, if that's a medium you prefer. Also just to provide you with invites to exclusive events, which, as I'd referenced, some of which are in-person live events around the world, others of which are online. And I'd also be happy to send you a free copy of my new book that is coming out in the next few weeks, with more insights and more examination on wealth building and how to create value in this exciting new space. So with that, thank you all for listening, and thanks again, Chris, for hosting.
An excellent presentation, and it's so keep up the great work, and I really for the audience, it was great value, and they be sure to, all of David's links will be in the show notes, and thanks again, and keep up the great work.
Absolutely, my pleasure.